Did you know that Ben Bernanke received word that Lehman Brothers, quote, can't survive? The question is when and how they go out of business, not whether. Months before the bank actually went out of business. My name is Emil Kalinowski. This is Making Sense. It's a Eurodollar University production, and I am joined by the esteemed, the incomparable Jeff Snider, Head of Global Research for Alhambra Investments. Good morning, Jeff.
Good morning, Emil. Back to Lehman Brothers, I take it?
Yes, let's travel back through time. It is June 13th, 2008. Only 94 days remain before the bank will file for bankruptcy. It's been in business for 160 years. Here's the news of the day, by the way, Jeff. Let's see. So from the Wall Street Journal, the Bank of Japan defends decision to hold rates steady. People may be thinking, yeah, they should be cutting. No. That means the BOJ effectively remains neutral on policy, even as central bank governors in the US and Europe have sharpened their anti-inflation rhetoric. That was the Wall Street Journal. Financial Times, the ECB calls for better access to sensitive bank data. Interesting. Back to the Wall Street Journal. Lehman bonds find stability. Okay, good. Wall Street Journal, the banking sector leads rebound in U.S. stocks. U.S. stocks recouped most of the previous session's heavy losses, boosted Thursday by encouraging developments in the financial sector. Treasury prices fell as consumers continue to buy. These are all headlines in the Wall Street Journal because the Federal Reserve is believed to move to raise interest rates to combat inflation. New York Times, BlackRock puts money behind Lehman. They're optimistic about the firm's prospects. Last story, New York Times, dollar on the cusp of the biggest gain in 3 years. There was other news, Jeff, that day that was private, and it arrived in Ben Bernanke's mailbox. What was it, Jeff?
Yeah, it was an email from Donald Cohn, the vice chairman of the Federal Reserve Board, who basically, as you said, you've already given us the spoiler to the audience that, hey, all this good stuff that's supposedly going on. Lehman Brothers raised $6 billion in equity, and Hank Paulson's in Japan talking about how great this is, that banks have learned their lesson, they're fortifying their balance sheet, and everything's good, except Donald Cohn told Bernanke that one of these hedge fund types in Cape Cod had told him that it was pretty much common knowledge across all of Wall Street that Lehman was finished. The question was whether, how, and what were the details of its bankruptcy going to be. Remember, this is June 2008. June 2008. As you pointed out with your headline survey there, what we were being told at that time was not what was being emailed between Ben Bernanke and Donald Cohn. It was actually the opposite. I'm glad you brought up the Bank of Japan, because that was one way that we saw that. What were central bankers thinking around the rest of the world? They had this under control. At least they thought they did. I mean, inflation was going to be the bigger problem. The ECB, remember, had raised rates just the month before. And yet, internally, at least in the U.S. part of the system, they were thinking, holy crap, we've got a huge, huge problem on our hands. 3 months after Bear Stearns, Lehman doesn't look like it's going to be able to make it. And not only that, I think one of the things that you also raised in one of your headlines was maybe we need the rest of the world to have more access into what's actually going on in these situations. Officials and policymakers have all of the information at their fingertips. They have insider sources, bank reports, bank examiners, rules, and all sorts of power at their fingertips. Yet, as we're going to see here, even with all that information, they don't seem to be able to understand what it is they're looking at.
Exactly. That might be the key takeaway from this episode, which I'll ask you at the end of this part. What is the key takeaway? But that might be it. And it echoes what we discussed in episode 39. This, by the way, is episode 40. Episode 39, part 1, where we discuss regulators' access to private data. And here we go. They've got inside information, not just this kind of email about rumors, right? Hearsay, rumors, that Lehman's not going to make it. But we had data, right? And there was somebody at the Federal Reserve that had access to a liquidity report that Lehman put together that was about the repo market, which we didn't know about. I didn't know about at the time. Of course, it turns out to be very important. what was in that table, that liquidity table?
Yeah, and it's not, let's be clear here. It's not just that we didn't have access to the information at the time. These are emails that are taken from exhibits and evidence gathered during the Financial Crisis Inquiry Commission's inquiry, supposedly into what caused the 2008 crisis. And these exhibits, these emails, and these other tables and data were kept under lock and key, hidden away for years afterward. And I believe this particular batch of emails hadn't been released until I think 2015 or 2016, just going off the top of my head. So for years after the crisis, this stuff was hidden. And so when you go back and look at it and you start to piece together what really happened, you can sense that, first of all, it's not what they said. Second of all, what they said in public was all total horseshit, pardon my French. And furthermore, they didn't, as much information as they had at their finger, they didn't know what they were looking at. They had no idea what was going on, what was really going on, but they did know that it was really serious. And so the email or the table that I talk about in the article in particular came from Lehman Brothers. It was a highly confidential internal memo that was circulated among Lehman Brothers senior staff that looked at their liquidity profile at the end of their second quarter in 2008, which was a week before the $6 billion equity drama unfolded. And so in early June, they said, look, we've got repo, our repo book outstanding was something like 188 billion, and that was down from 231 billion at the close of the first quarter. And that sounds like it's making progress, right? We're as it's been told in the years since, we're shrinking our repo book. We're reducing our dependence in short-term markets, when that wasn't the case at all. When you lose almost 50 billion in repo funding, that means a scramble for liquidity. And one of the reasons why was, as this liquidity report showed, of that 188 billion that was in the repo book, 105 billion of it was what they called non-traditional collateral types. And these are not necessarily subprime mortgages, but there's ABS, there's also all kinds of securitizations that aren't U.S. Treasuries, that aren't government agency collateral. So Lehman Brothers, as a bond house, as it was called in one of the emails, had been heavy into the securitization business, which was basically standard practice over the subsequent couple decades before then. And what they did was they packaged loans together and made securities, made bonds out of them. They literally conjured bonds out of illiquid loans. That was their entire business. Except if these bonds that you conjure out of illiquid loans are rejected by the repo market, you've got a major problem on your hands because you don't have collateral to stay funded and liquid.
And so now let's move forward. The Fed had this information. Let's move forward about a month to July 10th. Now there's only 67 days remaining in Lehman Brothers' life. And Carl Mocharko delivered some bad news. David Marshall and Kim Taylor said it was good news. Who are these characters in this drama, and what was it all about?
Well, the first one, the Mocharko fellow, was from Federated Investors, which is basically a money market fund manager. And money market funds, if you don't know, are heavy players cash side in the repo market. They're always looking to invest cash because that's really what money market is. It's a cash equivalent for investors. And so what he said, I believe it was July 10th, 2008, was, look, we're done. We're not going to transact any more repo with Lehman Brothers. And the reason we're not going to transact any more repo with Lehman Brothers was not because of Lehman Brothers. It was because of JPMorgan. That's really, the shocking part of all this is that their problem was that JPMorgan had been unilaterally rewriting the custodial rules for tri-party repo with Lehman Brothers and a lot of other places. And what Mocharko said was, look, we can't take it anymore. They keep inserting legal language that has all sorts of repercussions on our end. We don't care about Lehman. We got money to invest. And I think they said we have $500 million in that's ready to go for non-traditional collateral. I mean, they were Lehman's best dream at this point in July 2008. And what they're saying was, JP Morgan's just made it impossible. We can't do it. And by the way, Federated wasn't the only one that day that pulled out. It was also Dreyfus, because what JP Morgan was doing, as I said, they weren't just rewriting custodial language with one or two people. They were rewriting custodial language and updating terms for a whole range of cash investors on the repo side who might be doing business not just with Lehman, but other banks as well who are posting collateral. So there's a lot going on here. And at the time, the other two people that you mentioned, Emil, they worked at the Federal Reserve, in the I think it was David Marshall from Chicago said, look, I just got an email from this Kim person who says this is good. This is progress. This is something. This is a positive development. And again, understanding what's going on. Lehman Brothers is losing repo counterparties when it's already shaky to begin with, and they're doing so because of what JPMorgan's doing. They look at that as a positive because they think this is a non-economic factor. This is something that's not, the market's not pissed off at, or not, it's not moving funds out of Lehman. It's something that has to do with JP Morgan. They didn't understand the issue with JP Morgan, which was much, much worse than Lehman.
I'm confused. There's so many questions to ask. I guess I don't understand why they were thinking that this was good news, that the repo book was falling. I would think you would want it to be expanding. Okay, fine. And then the whole Federated.
Emil, it's almost like this year in COVID. This is Federated isn't worried that Lehman's shaky. This is what the Federal Reserve was thinking. They're pulling repo because of a technical factor. And you hear this all the time. I mean, how many times have we heard that over the last 13 years? It's a technical problem. There's a breakdown in funding.
But then what about Dreyfus?
Same thing, because JP Morgan was rewriting custodial rules up and down the entire tri-party repo custodial book. So it didn't just impact Federated, it impacted Dreyfus and all sorts of dealers too. When the Fed was saying was, look, we'll knock on JP Morgan's door, we'll tell them to knock it off, and everything will be magically great. Right? Wow. We'll say, hey, look, we're the regulators here. You're disrupting repo for reasons that you don't need to be doing this stuff, and everything will just go back to normal. They looked at this the exact wrong way. They thought Lehman Brothers is in trouble, but the market doesn't think so. The market wants to fund Lehman Brothers if only JP Morgan would get out of the way. That's why they thought this was a good thing, because they thought it was, it's JP Morgan doing something else, something, arcane and mundane and legal, not economic, right? It's not that the market hates Lehman and is afraid of its insolvency. They started believing that JP Morgan was just being obstinate.
It's because they wanted that result. They could have looked at either party and said, well, this party's right or that party's right. But they wanted the end of the story to be Lehman Brothers is okay. And JP Morgan was telling them a message by doing these bizarre, outrageous things to preserve their own keister.
JP Morgan, right? As we said earlier in the earlier email, the Cape Cod hedge fund type told Donald Cohn, look, we know Lehman's finished. And so you start putting all these things together. Why is JP Morgan doing this? Right?
Why?
It's one of those things. Right.
Why?
First of all, what was JP Morgan doing? Well, what they were doing, one of the first things they did is they rewrote the collateralization rules, which basically always said, look, we're going to margin your collateral based upon the repurchase price. And the repurchase price is what Federated gets together with Lehman every day, and they say, this is the price of your collateral. And JP Morgan says, I need this much margin from Lehman based on the repurchase price you guys have come to, where it is in relation to the market price, right? That's how repo works in the tri-party setting. If the market price moves compared to the repurchase price, then the JP Morgan's going to say, I need more collateral from Lehman, I need less collateral from Lehman, I need more cash from Federated, all sorts of other things. What they were saying now is, look, we're changing the language from repurchase price to sale price, or original purchase, or cost book value price, which is what the security would have been worth when it was put together. Because remember, these are securitized packages, and mortgage bonds and things like that. So what understanding, reading between the lines here, especially in the context of 2008, think about even a prime mortgage bond's price compared to its book value in June 2008 versus what it was in 2007 or earlier. It's much lower. So Lehman Brothers is thinking, I'm getting full collateralization and repurchase price at the market value, when JP Morgan is saying, no, this bond has fallen materially. We're going to need margin based on the book price. So it's essentially a collateral call, and a unilateral collateral call on Lehman Brothers' book, which Federated was saying, look, you're imposing these rules upon Lehman, and Lehman's saying, wait a minute, this has nothing to do with you, JP Morgan. This is between us and Federated. What do they care if we're repoing based on the repurchase price? Because as far as Federated is concerned, as long as the repurchase price is close to the market price, we're good, right? Because they can sell it at the market price.
Let's step in here then, Jeff, because maybe we should have done this a few minutes ago. Why is JP Morgan even involved if it's a deal between those two. It's because of a tri-party system. Explain to us how this system works. What was JP Morgan's role? And then we'll get into the fact of what JP Morgan was thinking, why they were doing this.
Well, the tri-party repo system is nothing more than a clearinghouse. JP Morgan, as a bank, acted as a clearinghouse to basically take care of all of these trades, so that Federated and Lehman Brothers didn't have to do that between themselves. As most repos done OTC, bilateral, bespoke, that kind of thing. So it's basically JP Morgan saying, I'm going to provide custodial services, batch book, all sorts of other things. Taking care of your collateral, taking care of your cash, settling, unwinding, all of the things that need to do in the repo market on behalf of the collateral side and the cash side. And so JP Morgan isn't just a disinterested clearinghouse, though, because as part of its custodial arrangements, it has some legal recourse as well as some legal liabilities. And if some of these trades start to go awry, who's on the hook for them? Well, ultimately, that's what JP Morgan was saying is, look, we're looking ahead here. Yes, Ben Bernanke and Hank Paulson, everybody says things are going well, but let's not forget, we're the firm that had to absorb Bear Stearns when we didn't want to just a couple months ago. We know what's going on in the repo business, by the way, because a lot of tri-party repo flows through our own book. So we see on the inside what's going on in repo. And looking ahead here, maybe as JP Morgan is nothing more than a custodian, we've got some potential problems to look at and prepare for. We can see this repo business as it really is, and it's starting to scare the hell out of us. Scare the hell out of us so much that we're unilaterally rewriting custodial language, which are legal documents. Not all of them are boilerplate either. But a lot of them are these legal documents. Custodial documents are things that have been used in standard practice for decades. And all of a sudden, JP Morgan's saying, look, we're going to start unilaterally rewriting changes into both sides of it. And it wasn't just, sale price versus repurchase price on collateral. It was also split indemnity. And basically, JP Morgan wrote into the document language, hey, both Federated and Lehman, and all these other, but not just those two, but all the other in the repo book, they're going to indemnify JP Morgan against any losses from simply taking orders from both sides, which is language that that kind of blanket indemnification had never been a standard practice. It had never been any practice that I'm aware of. And so you put that together with the repurchase thing. With Lehman Brothers specifically, JP Morgan said, look, we have the right now to simply repay Federated for any under-collateralized situation and then charge Lehman for the interest of doing so, which is, again, looking ahead and saying, look, if some of this collateral starts to lose value, we get stuck with it. We're on the hook to Federated. We're going to use Lehman's cash to do so. And also, we're going to raise the margin on Lehman while we do it. So again, it's all of these things where JP Morgan is saying, look, this isn't a Lehman Brothers problem. It's a systemic problem that's scaring the hell out of us.
And so now we're moving forward to September 13th. And so the iceberg that's going to sink the good ship Lehman is only two days away, and it's not over the horizon. It's perfectly clear. It's not underwater. It's coming clear as day. And Christopher Saboy wrote something that day, Jeff, that speaks to what you were just talking about, that it wasn't Lehman. It was the whole repo market. And he went through all the different subsidiaries. Can you tell us what we should take away from that email?
Well, there's two parts to this. There's the repo market and then what the repo market does. And I think it's, in common perception, it might be that the repo market is a funding market. Well, what the hell does that actually mean? Funding market for what? And it's okay, you have collateral, but as we talked about last week with the non-harmonized global rehypothecation regimes, the idea of collateral itself is kind of, it's tricky. It's intricate. There's more to it there too. And so it really, on the surface, this repo stuff sounds very, very simple, right? It's a collateralized lending arrangement. You give me collateral, I give you cash. Tomorrow we unwind the trade, and more than likely, we do it all over again. And we do this day after day. And it's a collateralized lending arrangement that should be really simple, safe, easy, and effective. Except no, there's all this other stuff behind it. As JP Morgan was pointing out to the regulators, anybody who would listen, really, this collateral stuff was scaring the hell out of them, because not just valuations and such, because it was so widespread and how it was used. They weren't really sure who would be on the hook for losses, or who would be on the hook if some of these trades didn't unwind properly. So there's all that stuff going on the collateral side. And then the other side of it is, what are these repo users doing with all this collateral? What are they funding? Well, they're funding everything. They're funding their entire money dealing activities based in large part on what's going on in their repo book. And so in terms of a company like Lehman Brothers, that meant in other subsidiaries, not the subsidiaries that are doing the repo, but other subsidiaries in Lehman, these other groups, part of Lehman Brothers under the parent umbrella, that have massive derivative books that are funded in large part by what these subsidiaries that are doing the repo are doing in repo. So you have Lehman Brothers Inc., which was the U.S. subsidiary, which was doing a lot of these securities financing transactions. You have Lehman Brothers International Europe, which we talked about last week, which had all the collateral to do the repo financing. And then you have all of these credit facilities and arrangements that go between the parent and the subsidiaries and all these other places that essentially tie everything together. But what it really ties it to is these two subsidiaries that are in the repo market funding a lot of these marginal activities. So Lehman Brothers derivative books were very much tied to what happened with the ability of Lehman Brothers to source funding in repo. And that meant collateral and all these other things.
Now, ladies and gentlemen, I have done my best to try to convey the excitement I had when I was reading this article, but I don't think I have. But it read like a thriller. It read as good as any of the movies you have seen about this crisis. And the article, if you wanted to read it, if you wanted to read the different emails, the arguments that people were having, and experience that kind of countdown towards inevitability, then go to Real Clear Markets and you'll see the article posted today, the 18th of December, and it's called Vaccine Euphoria and Inflation Hysteria Obscure the Dollar Problem. Jeff, we could go on, but we should probably wrap it up. Is there anything that I didn't touch on? Any fable? The moral of this fable? Is there anything that we didn't convey to the audience?
Well, I think we've conveyed it, but the moral, just to sum up again, is that, look, first of all, this money stuff is incredibly complicated. It's really intricate. It's really detailed. It's really involved and complex. Second of all, monetary officials, central bankers, government officials, regulators, they have no idea. They have access to all this information, but they have no idea what they're looking at because they have no frame of reference to interpret it, because they're all 60, 70, 80 years behind the times. And so when they confront this situation, like we said before, they say, oh, Lehman Brothers, it's JPMorgan. JPMorgan's just being obstinate. And once we knock on JPMorgan's door, they'll see the light and everything will go back to normal, when they couldn't comprehend what everyone was telling them, that this was not a Lehman Brothers problem. It was a systemic problem. And so that's part of the real message here, is that, look, this isn't just about 2008. Even in 2020, when we have, the breakdown in March, regulators say, oh, we did a really good job because there wasn't another Lehman Brothers, when in fact, look, they don't really know what they're looking at. They have all the information in the world that we can only dream of getting our hands on, especially in real time. It's a treasure trove 5 years and 6 years later, but in real time, they have all the data and they have no idea what to do with it. And the results show us that. And the results, which are germane to 2020, going into 2021, are deflationary, not inflationary. When they have no idea what's going on in the monetary system, and you have the rest of that monetary system telling you what's going on, whether it's from market prices or things like that, you can understand and appreciate why they would make these kinds of big mistakes.
One of the central figures of this story is JPMorgan. And in part 2, we're going to discuss what the bank is up to more recently.